All right, let's talk about Magna International, because what just happened with their Q4 earnings report? Wow. This wasn't just a good quarter. This was the kind of report that sends a shockwave through the market, sends a stock into orbit, and totally changes how everyone looks at a company.
So here's how we're going to break it all down. First, we'll look at exactly why the stock popped so hard. Then we're going to dig past the kind of weird headline number to see what's really going on underneath. After that, we'll get into their margin story, their guidance for the future, and we'll wrap it all up with our take, the next call. So first up, a quarter that popped. And really, popped might be an understatement. When these numbers dropped back on February 13th, the market did not hesitate for a second.
I mean, just look at this. The stock absolutely skyrocketed, a nearly 19% jump in a single day. You just don't see moves like that on a big, established company like Magna unless the market is screaming one thing loud and clear. We love what we're seeing.
So what was the rocket fuel here? Well, it was this, a monster beat on earnings. They didn't just squeak by what analysts were expecting. No, they blew past those estimates by a whopping 21%. A beat that big, it forces everyone on Wall Street to stop, throw out their old notes, and completely rethink the story.
Okay, Section 2, Beyond the GAAP headline. Now this is where the story gets really, really interesting. You see, the official headline number, the one based on standard accounting rules, was, well, it was confusing. But the market saw right through it. This is a classic case of smart money finding the real signal in the noise.
And this slide just lays it out perfectly. On one hand, you have the official GAAP earnings per share, which was 0, a big goose egg. Why? Because of a huge, non-cash write-down. But then you have the adjusted number, what the business actually earned, a massive $2.18. The market knew exactly which one of those two numbers really mattered.
And just to be clear, this wasn't some financial magic trick. The actual nuts and bolts business was on fire. Their core operating profit, EBIT, shot up 18%. And get this, their profit margins got wider by a full percentage point even while fewer cars were being made globally. That, right there, is pure operational muscle.
And what happens when the business is humming like that? It prints cash. A lot of cash. We're talking over $1.3 billion in free cash flow in just a single quarter. That's like having a war chest. Management has all the options in the world with that kind of money.
So the big question is, how? How did they pull this off? Well, that brings us to part 3, the margin expansion story. Because that margin growth, it was no accident. It's the result of a plan they put in motion years ago, and it is finally paying off in a huge way.
You heard the CEO, Swami Kotagiri, talk about it. He calls it operational excellence initiatives. And, it's easy to dismiss that as just corporate buzzwords. But this quarter absolutely proved it's the real deal. The proof is right there in the numbers.
So what does operational excellence actually mean on the factory floor? Well, it means they're rolling out a single digital system so they can see what's happening everywhere, in real time. It means they're using AI to catch defects before they become a problem. It means they're finding smarter ways to move parts around to save money. These are real changes, saving them real cash.
And here is the bottom line on all of that. These improvements are expected to add up to almost 200 basis points, that's 2 full percentage points, of permanent margin improvement by 2026. This is not a one-time thing, folks. This is a fundamental, sustainable change in the profitability of the company.
All right, so with that incredible performance behind them, what's next? That brings us to Section 4, Guidance and Shareholder Returns. See, management didn't just deliver a great quarter, they gave us a very, very confident look at the road ahead.
And that guidance is strong. I mean, really strong. They're projecting sales hitting as high as $43.5 billion. Those margins we just talked about, they see them getting even better. And that cash flow machine, it's going to keep on printing to the tune of $1.6 to $1.8 billion for the year.
But here, this is the part that really got investors excited. They plan to buy back around 22 million of their own shares this year. Just think about that. It's a massive sign of confidence from management, and it acts like a guaranteed tailwind for the stock price. Fewer shares just means your slice of the pie gets bigger.
And if that wasn't enough, they also hiked the dividend for the 16th year in a row. So you put it all together, a massive buyback and a growing dividend. The message couldn't be clearer. We are making a ton of cash, and we are giving it back to you, the shareholder. Which, of course, brings us to our favorite part, the next call. The final question that every investor is asking right now.
So here's the billion-dollar question, right? Where does Magna stock go from here?
After a run like that, after that huge pop, is all the good news already baked into the price? Or is this just the beginning of something bigger?
Well, here at TalkTurkers, we've put together our investment thesis, and we see a clear three-part case for why this story is far from over.
First up, the thesis itself. And it's simple. This quarter was not a fluke. It is the direct result of that operational excellence plan we talked about. This is creating real, lasting improvements to their profits and cash flow. We think the market is only now starting to truly believe that management can deliver. Second, you need a catalyst. And boy, do they have one. That plan to buy back nearly 22 million shares? That is pure rocket fuel for the earnings per share. It's a built-in accelerant that should help provide a tailwind for the stock all year long.
And all of that leads us to our rating, outperform. We're convinced Magna is going to beat the broader market. Why? Because management has proven they can execute, and their plan to return cash to shareholders is just too compelling to ignore. The story here has fundamentally shifted. It's no longer a turnaround story, it's an execution story.
And of course, this is not financial advice.